Stock market staged a partial rally after the weekend as investors hoped that the worst week in the market since the financial crisis had maybe gone too far too fast. A rush to take risk off the table last week had seen the S&P 500 index fall 14% since the all-time high reached as recently as February the 19th. The falls were widespread, with the global market index 11% lower over the week. Monday saw Asian shares bounce back, with China's CSI 300 index of Shanghai and Shenzhen listed shares rising by 3.3%. Japan rose by 1%. There was an initial follow-through in European markets, although the rally was short-lived as gloomy headlines continued to depress sentiment. By the time the market day had moved on to the US, however, the mood had clearly lifted and the S&P 500 rose 4.6% on the day, one of its best ever. The rebound brought Wall Street back out of correction territory, down 8.8% from its recent high. The outlook remains uncertain, however, and early trading on Tuesday has been mixed. Japan ended up 1.4% lower, reversing a 1.7% gain. As investors turned their back on risky assets last week, safe havens were in favour, with gold and government bonds rising. The yield on the benchmark US 10-year Treasury bond hit a new low of 1.15% on Friday. That provided clear evidence that investors now view the coronavirus as a global crisis and no longer a China-only issue. The death toll continues to rise around the world, with Iran the worst hit country outside Asia. Italy is the worst affected country in Europe, but almost nowhere is completely free of the virus now. Attention is shifting from the spread of the disease to the likely economic impact, with the OECD warning that global growth might halve from its previous forecast. The widespread closure of Chinese factories could by itself cut worldwide growth by 0.5%, reducing forecast growth for 2020 from 2.9 to 2.4%. But the Paris-based organisation warned that growth might fall as low as 1.5% if there were a longer-lasting outbreak. The scale of the impact of the coronavirus outbreak reflects its influence on both supply and demand. The importance of China in global supply chains and the location and timing of the initial outbreak have caused significant disruption for many global manufacturing businesses. Meanwhile, the fear of infection and the measures taken to control the outbreak have reduced demand for goods and services, with some industries like aviation and luxury goods notably affected. The latest economic data from Italy underscored the risk that coronavirus could tip vulnerable economies into recession. February was Italy's 17th consecutive month of declining manufacturing activity. On Sunday, the Italian government said it was planning to inject 3.6 billion euros into the economy, which contracted by 0.3% in the final 3 months of 2019. In China over the weekend, the official PMI index fell to 35.7 in February. That was an all-time low. It was 50 in January. The collapse reflects the difficulty factories and other businesses have had in reopening after the New Year holiday, as migrant workers have been forced to undergo quarantine. In South Korea, export orders have fallen at their fastest rate in 6 years. Exports represent 45% of South Korean GDP, and Hyundai car sales fell to their lowest in a decade. The big question for markets now is whether the coronavirus outbreak will lead to a global recession and the extent and scale of the response by governments and central banks. The initially positive market reaction on Monday reflected a forthright announcement from the Bank of Japan, which said it would provide ample liquidity and ensure stability in financial markets. In central bank language, that was close to saying it would do whatever was required. Australia cut its interest rate by 0.25% to 0.5% on Monday. Expectations are high too that the Fed will swing into action at its meeting ending on March the 18th. According to Fed futures, the chance of a 0.5 percentage point cut in US interest rates is now 100%. Jobs data on Friday will give an early indication of the coronavirus impact on US activity. The day before that, actually, OPEC ministers will gather in Vienna to discuss another substantial cut in oil production of maybe up to 1 million barrels of oil a day. Brent crude recovered somewhat on Monday, but at just over $50 a barrel, it remains well below its 52-week high of $75. Now, turning away from shorter-term market movements to the outlook for the rest of 2020, the US presidential election remains a key influence. This week is more important than most because Super Tuesday is the day when the Democratic candidate may effectively be chosen. This is the week when 14 states hold their primaries, deciding a third of the delegates who will vote in July when the candidate is officially named. Bernie Sanders has emerged as the front-runner, and another strong performance by the left-winger from Vermont may be enough to clinch his nomination, although the moderate wing of the party appears to be swinging behind Joe Biden in a last-ditch attempt to avoid a Sanders win. That would have a big influence on markets one way or the other later in the year, either because investors would start to price in the possibility of a self-proclaimed socialist entering the White House, or because a Sanders candidacy would make another 4 years of Donald Trump more likely. On this side of the Atlantic, the political spotlight is split between next week's budget and the UK's trade negotiations with the EU, which kicked off on Monday. The budget will be presented on Wednesday, the 11th of March, by new Chancellor Rishi Sunak, with attention focused on how the young and inexperienced new boss at the Treasury will deal with a range of uncertainties, from coronavirus to Brexit and the need to even out the UK's unequal distribution of wealth and opportunity. Of particular interest to investors will be the government's approach to pensions, with speculation rising about an increase in the age at which people can access their defined contribution pensions, and possible restrictions on pension contribution tax relief and entrepreneurs' capital gains tax relief. Meanwhile, in Brussels, the UK and EU will sit down to begin wide-ranging talks covering trade in goods, security cooperation and fishing rights. In the build-up to this week's talks, both sides have played it tough. Britain has emphasised its political independence and warned Brussels that it is prepared to walk away from talks in June if there's no prospect of a decent deal being struck. For its part, the EU has told London that market access to the EU will only be possible alongside policy and regulatory alignment. And finally, the quarterly FTSE reshuffle is due to take place this week, with the impact of coronavirus likely to be a factor. Travel companies TUI and EasyJet, as well as B&Q owner Kingfisher and NMC Health, are in danger of dropping out of the FTSE 100 index. EasyJet's share price has fallen by more than 25% in a week.